The Investor Channel. I'm Wayne Abraham, your financial guide. It's the channel where we're talking about personal finance, setting goals, achieving goals, teaching our children financial intelligence, giving them information so they can be financially educated, and breaking the cycle of generational poverty by learning and taking action. Welcome back to the channel if you're a regular subscriber. If you're new, welcome. This is what we do. This is what we do. We get ourselves educated, we take action, and we break the cycle of generational poverty. We teach our children so they can continue to keep this going. Continue to like, subscribe, hit the notification bell on YouTube with MD Investor, on Instagram with MD Investor 1. Today's video, guys, we're going to continue with building out a dividend portfolio. Building out a dividend portfolio. The last few videos we've been talking about, building a portfolio so we can generate passive income. That's the ultimate goal on our path to financial independence is passive income. We're going to do it with dividend, lots of dividends, mountains of dividends. So the two options we have to do it is picking companies one by one. So pick the company, do the research, go on the investor relations, look at the 10Q, look at the 10K, and kind of decide to pull the trigger and buy the stock and continue to build up our position. The other way to do it is to buy an ETF, which is the subject of this video. Basically, building your dividend portfolio by buying an ETF. And as you guys already know, an ETF is basically almost like an index where you buy one share, but you are wholly diversified because it's almost like a mutual fund. You buy one share, and that one share is invested in multiple baskets. So today we're going to talk about Noble. Here it is. ProShares offers this product called Noble, and it is an SP 500 Dividend Aristocrat ETF. Last video we talked about Dividend Aristocrats, which are basically companies that have raised their dividend for at least 25 years. They call them Dividend Aristocrats. And in the SP 500, as you know, the SP 500 is basically an index with 500 of the biggest companies in America. Not all of those companies pay dividend in that S&P 500 index. Some of the growth companies, the more popular companies, such as Google, doesn't pay a dividend. Amazon, Facebook, they do not pay a dividend. So none of those companies will be in this S&P 500 Dividend Aristocrat ETF. Because to be in this ETF, you have to be one in S&P 500. Two, you have to pay a dividend, and three, you have to pay a dividend for at least an increasing dividend for at least 25 years. So if you're in the S&P 500, you pay no dividend, you're not there. If you're in the S&P 500 and you pay a dividend, but you have not raised it, you're not there. And if you're in the S&P 500 and are paying an increasing dividend, but it's less than 25 years, you're also not there. So these companies are basically rock solid blue chip companies, names that you know, and it's actually a great way to start. It's actually a great way to start. So let's take a look and at some of the fund objectives. It says ProShares S&P 500 Dividend Aristocrats ETF seeks investment results before fees and expenses. Very key, before fees and expenses that track the performance of the S&P 500 Dividend Aristocrats Index. Okay, so there's going to be fees and expenses because of the ETF. And let's hear, we kind of reviewed this already, about the fund. So the ticker symbol is Noble, N-O-B-L, like a nobleman aristocrat. Noble's holdings are the S&P 500 Dividend Aristocrats. High-quality companies that have not just paid dividends, but grown them for at least 25 years, with most doing so for 40 years or more. Often household names. So this is going to be names that you know. Noble Holdings generally have had stable earnings, solid fundamentals, and strong history of profit and growth. So those are the thing that we're going to look at, guys, when you're trying to get a portfolio going. Noble strategy has a demonstrated history of weathering market turbulence over time by capturing most of the gains of rising markets and fewer of the losses in falling markets. Okay, let's look at some of these the fund details. The inception date, October 9th, 2013. The trading symbol is Noble, NOBL. The net assets is about $6.5 billion. Expense ratio. We've talked about expense ratio before with mutual fund. The expense ratio is 0.35%. So something to consider, guys. The distribution schedule, you get paid quarterly. Let's look over here, the fund's performance and index. So ProShares S&P 500 Dividend Aristocrat ETF, NAV, I think net asset value, total return. So for the fourth quarter of 2019, it returned 6.28%. Year to date, 27.45%. This is not bad. Then they show you the 1 year, the 3 year, the 5 year rate of return. 1 year, 27.5%. 3 year, 14.3%. The 5 year, 10.8%. And since the inception, 12.98%. Okay? And I need to show that over here is just some different information like the total return. Essentially about the same thing. The S&P 500 Dividend Aristocrat Index is going to be very similar because it basically it mirrors it. Okay? And then the S&P 500 as a whole, fourth quarter 2019, returned about 9%. And the reason why this may be that some of those growth companies that don't pay dividends, like Facebook, Google, Amazon, would be in that. Okay, that's probably giving it a higher return here. That's probably explaining the higher return between the S&P 500 overall and the Dividend Aristocrat. The Dividend Aristocrat, a lot of them are more older, stable companies that are not growing as fast. Okay, now this is a pretty interesting graph here. They said hypothetically, if you had $10,000 and you invested it in the Dividend Aristocrat, since Noble inception, which is 2013, right? Noble inception, 2013, October. They said you would have right now, in the end of 2019, your $10,000 would turn into about $20,000. Okay. Okay, let's see what else we can see here. So, index description. So, the S&P 500 Dividend Aristocrat Index, it invests in the S&P 500 companies that have increased dividends each year for at least 25 consecutive years. We said that, right? Very key. So, these are stable companies. And it contains a minimum of 40 stocks, which are equally weighted. We're going to get back to that in a minute. And there's a limit. It limits the weight of any single sector to no more than 30% of the index. That goes back to what we call about diversification. You don't want all your eggs in one basket, right? So here it said it limits the weight of any single sector to no more than 30% of the index. So they don't want 30% in financials or any other sector, because they want to be diversified. The reason being, if something were to happen in that one sector that you're super overweight in, right? Say you're 50% in financials, and then all of a sudden the bank crashes, like in 2008. Financial sector crashes. Then it's going to have a drag on your portfolio. But if you're diversified and you have a little here, a little there, it'll mitigate your losses. It rebalances, or the index is rebalanced each January, April, July, and October. So they rebalance it. Okay? So for example, if this sector is kind of running up and it's kind of overweighted, maybe it's got to 32%, they got to bring it back down. And they do it 4 times a year. With an annual reconstitution during the January rebalance, which basically means that in January, they kind of take a look at everything and said, okay, you know what, Do we really need to keep this stock? It hasn't been performing well, or so and so, or maybe it did not meet certain criteria, and maybe they'll take it out. Okay. So the index description has been around since the inception, May of 2005. Okay. Okay. Now this graph over here, it's comparing the S&P 500 as a whole, S&P 500 as a whole, to the S&P 500 Dividend Aristocrat Index. And you see, for the most part, they're pretty close. The 1-year return for the S&P 500 Dividend Aristocrats is about maybe it's about 27%, and the S&P 500 is a little higher. And we said that could be some of those super growth stock, what they call the FANG, FAANG, Facebook, Amazon. I wouldn't say Apple, because maybe Apple also, because Apple, even though it pays the dividend, it hasn't paid it for 25 years. So Facebook, Apple, Amazon, Netflix, and Google, those type of growth companies, is probably the reason for this difference. The 3-year return is pretty similar. The 5-year return pretty similar, about 12%. This graph is looking at the standard deviation, meaning the difference. For the most part, not a significant difference. Let's get over here. The top 10 fund holdings. So in this S&P 500 Dividend Aristocrat Index, the top 10 companies, Target, or some call it Target, 1.94%. AbbVie, it's in the pharmaceutical space. It's split a part of Abbott Labs. AbbVie, 1.92%. Leggett and Platt, probably a company you've never heard of, but they probably make everything. Well, let's put it this way: what you sleep on, they're involved in that. So I know they're involving making the springs in a mattress and other really non-sexy industrial products that we need to live, carpets and other things like that. But again, companies we never heard of, but paying dividends for a long time. Johnson & Johnson, 1.91%. Archer Daniels Midland, we talked about that before, involving food and food processing. Stanley Black & Decker, and then industrial. Illinois Tool Works, 1.87%. Dover Corporation, never even heard of that one, 1.86%. Ale Products and Chemicals, I think that's in the chemical space. Becton Dickinson, 1.84%. So you see here, the top 10 holdings make up less than 20%. That's what you call diversification. That means the other probably 40 companies is going to make up the other 80%. That's what you want. So if something were to happen to, say, Black & Decker, and the stock drops, it's less than 2%. It's really not going to affect you. Even look at Johnson & Johnson right now, right? They're having all the lawsuits now over the opioid epidemic. They're a great company, but represents less than 2%. So if something were to happen and that stock dropped and maybe stop paying a dividend, it's really not going to affect you that much because you are diversified. It's representing less than 2% of your portfolio. And this is the fund sector, guys. We had a video where we talked about diversification, where you want to have your money split and divided in different sectors of the economy. These are the different sectors of the economy. Industrials, those are the companies that would make like involved in manufacturing. So 3M would be an example of a company in the industrial space. 3M. Another company that comes to mind would be United Technologies. They're involved in making elevators and different industrial products. Consumer staples, stuff that you need. So companies that make food, Hormel, PepsiCo, they would be in this space. Okay, financial, that'll be your banks, your insurance company. They'd be in the financial space, 11.72%. Healthcare, that'll be your Johnson & Johnson, maybe your AbbVie, 10.95%. Consumer discretionary. So discretionary because we really don't have to buy it. So that would be like your retail, 10.87%. stuff that we don't really have to, we don't really have to get. We don't really have to go to McDonald's, right? I mean, we need rice and potatoes and beans and meat, but we don't have to go to McDonald's. So that'd be consumer discretionary, 10.87%. Materials. So that'd be maybe company involving making um, um, maybe fabric or maybe other materials that we will need. Okay, energy. So maybe like your Exxon Mobil, 3%. So even if oil prices crash, only 3.3% of your portfolio. Communication services. So you think about like your AT&T, information technology, maybe your Apple, utilities, your Con Ed, real estate, maybe your REITs, real estate investing in trust. But the bottom line here, you see, it is diversified amongst the different aspects of the economy. You buy this one share of ticker symbol Noble, Nobl, right? S&P 500 Dividend Aristocrat Index Fund, and you have a little of everything. They gave us already with the top 10 top 10 companies, right? But let's see what exactly is in, when you buy this ETF, we know you're paying 0.35% expense ratio, which we said, you got to consider that. But before we look at what's in it, right, let's look at some of the index characteristics. There's 57 companies in this Noble Dividend or S&P 500 Dividend Aristocrat ETF. 57 companies in there, right? They have the criteria of raising their dividends annually for at least 25 years. They're in the S&P 500. The average market cap, so these are big companies. Average market cap, $83.5 billion. We have a video about market cap. So these are big companies, okay? Price to earnings ratio, PE ratio, 20, right? Which we said, we like the 10s, 9s, PE ratio maybe to about 18 as considered we're getting a good value. 20, maybe still getting a good value, but it's getting a little pricey, which makes sense. These are great, solid companies, okay? So PE ratio of 20, which basically means that you have to get $1 of earnings, you're investing $20. Okay? Dividend yield. The dividend yield of this Dividend Aristocrat, you add them all together, all their dividend yields are averages 2.40%. Obviously, some of them are going to be higher, like the utilities, 5%. AT&T is going to be like 5.5%, and some of them are going to be a little lower. But the average is 2.40% dividend yield. The 2019 annual turnover is about 17.5%, which means that every year people who run the fund may look at it and say, this is performing well, this is not. This is performing well, this is not. Let's take this out. So there's 17% turnover. Let's get back to the companies that are in this ETF, right? Noble, right? ProSure, S&P 500 Dividend Aristocrat ETF. What are the companies that are in there? We said there are 57 holdings, right? As of the end of January 31, 2020, they're very current. The rebalance and the reconstitution. This is the companies that are in there. We kind of went through some of these a little before. Names that you know. 3M in industrial space. We talk about that. 57 years of paying a dividend. Coca-Cola. Colgate. When you buy this one ETF, you are diversified. You are absolutely diversified. If you're going to do this one company at a time by yourself, obviously it's going to take a while, right? You buy a couple of shares of whatever, pick one, AbbVie, and then you buy a couple of shares of Pepsi, and then maybe you buy a couple of shares of AT&T. But you buy this one ETF, and you are diversified. You're diversified across sectors. You have industrial. You have Coca-Cola. You have consumer staples. You have Colgate Palmolive. We all got to brush our teeth with a Colgate toothpaste. Arm & Hammer baking soda. Dover Corporation is industrial. I don't know what that is. Emerson Electric, industrial. Genuine Parts, consumer discretionary. Johnson & Johnson, healthcare. You buy this one ETF, and look how diversified you are. Procter & Gamble, that's your consumer staples. That's your Dial soap. That's your What else Procter & Gamble makes? Your Kleenex tissue. You have your Stanley Decker, your Hormel. So you basically see that great companies, your Target, your Kimberly Clark, your Pepsi, great companies, and you have a little piece of everything, of all of them. Lowe's, Walgreens, Clorox, McDonald's. You have a little piece of McDonald's. You have Walmart. Okay, over here, and look at the length of years they have been increasing their dividend. Some of half a century. Medtronics, Sherwin-Williams, Aflac, ExxonMobil, AT&T, Ecolab, T. Price, McCormick with the spices, Cardinal Health, Chevron, which is in the energy space. I mean, it just goes on. It goes on. It goes on. It goes on. It goes on. People's United Financial is in the financial space. So you are diversified. Absolutely, you are diversified. So, what are the pros and cons? Well, one of them is that it's easy, right? Because if you were going to have to buy one company at a time, do the research, do this, one company at a time, it's going to take a while. You buy this one ETF, and it's almost like set it and forget it. They rebalance it for you. The companies that maybe they're not performing, they drop off the index, and you just sit back and drink your latte, drink your cappuccino. Obviously, so that's the one, the pros. Okay, it's like a set it and forget it mentality. The companies there are well-established company. They've been paying dividends for years. It gets rebalanced. What are the downside? I'd say two downside that I see. Two downside that I see that we see that the average dividend yield was 2.4%, right, of all 57 Dividend Aristocrat, which is not bad. But what if you're a person that say, you know what, I'm building my dividend portfolio and I want a yield of at least 5-6%. This wouldn't get you there by itself. And the reason that being that some of these companies in here, like AT&T, are paying 5.5% dividend yield. AbbVie, 4.5% dividend. Some of the high yielders. But then you have other companies that are paying maybe 0.8%, maybe only 1%. So when you take that in aggregate, on average, you get your 2.4%. You can't pick and choose because you buy one share of the ETF and you get the whole basket, right? It's like you go to a Chinese store and you said, give me the combination. And it has fried rice and it has the soup, it has the wonton soup, and it had the egg roll, and you say, you know, I don't want the wonton soup, but you buy the combination. Buying an ETF is basically buying the combination. So the downside is that you are not able to say, you know, take this out and only give me this part. So that's one of the downsides. If you were picking stock yourself, you could say, I don't want anything that's paying a yield less than 2.5%. You can do that. If you're building your own, you can do that. You know, you can look at the 2.5%. Does not meet my criteria. I want only 3% and up. And you can do that. You also, when the downside is that the weighted is already weighted for you. Like, for example, we saw that Johnson & Johnson was 1.89%. Leggett & Platt, 1.89%. But you know, if you want to make Johnson & Johnson 5% of the portfolio, you can do that. Because in the ETF, it's built that way. But if you're building your own portfolio, you could say, I want Johnson & Johnson to be 5%. I want Abbott to be 3%. I want McDonald's to be 4%. But here you can't do it. That's one of the downside. So let's see, what is the takeaway? If you're looking for high yield, large cap stocks, meaning over capitalization over $10 billion, consider a dividend growth strategy. ProShares SP 500 Dividend Aristocrat ETF, ticker symbol NOBL, is designed to track before fees and expenses the SP 500 Dividend Aristocrat Index, a rare breed of companies that have not just paid dividends but grown them for at least 25 consecutive years. Guys, so I hope this video whet your appetite that there's many ways to get to Rome. You can get to it by just buying one share of the ETF, and other companies might offer to, you know, I'm not pushing ProShares, but I'm just saying other companies might offer it too. But this is an easy way to go. You quickly get diversified immediately. But the downside is you're gonna pay that fee, that 0.35% expense ratio. You're also going to have limitations and you being able to pick and choose, the dividend yield is not going to be as high as maybe you would like it, only 2.4%. But on the pro side, you're automatically diversified amongst 50 companies who are built in solid, long history of dividend growth. It gets automatically rebalanced for you. So it basically depends on kind of how you want to go. If you're a person who said, I want to take a little more active role, I want to take a little more active role and maybe do a little research and pick the company that I want to invest in, and then it gets me more freedom. I can pick companies with higher yield. I can leave out the low yield. So there's a quick video, guys. This is how we're doing in 2020, guys. Building from the ground up. Begin to build our passive income machine. So don't forget to like. Don't forget to subscribe. And definitely hit the subscription bell so you'll be notified when new content comes out. If there's people out there, guys, who are struggling, working 2-3 jobs, not getting ahead because they don't have the fundamentals in place, let them know about MD Investor. On Instagram, it's MD Investor 1. And just remember to not just learn, but take action. Command your money to grow. And I will see you on the next video.